There is a specific quality of silence that exists only in the presence of immense, accumulated capital. It is not the silence of an empty room, but the heavy, insulated quiet of a vault where the air itself seems preserved, filtered, and kept at a constant temperature to prevent the decay of paper and the tarnishing of silver. In the late summer of 1889, amidst the clattering chaos of Chicago, a city that smelled of stockyards, unwashed labor, and burning coal, a man named Byron Laughlin Smith decided to manufacture this silence. He opened a single room on the second floor of the Rookery Building on LaSalle Street. He did not seek the loud, frenetic business of the speculator or the desperate, sweaty commerce of the grain trader. He sought the business of permanence. This was the birth of the Northern Trust Company, an institution that would become the spiritual home for a very specific breed of American wealth, the kind that does not shout its existence but rather whispers from behind high walls. Smith understood a psychological truth that escapes most modern entrepreneurs, which is that the creation of wealth is a violent, chaotic act, but the preservation of wealth is an act of neurotic, obsessive control. To understand the Northern Trust, and by extension the financial architecture of the American elite, one must first distinguish between the mechanism of a bank and the mechanism of a trust. A standard commercial bank lives by the spread, taking in deposits from the common man and lending them out to the ambitious man, gambling on the gap between interest rates. It is a business of risk and velocity. Byron Laughlin Smith was not interested in velocity. He was interested in the trust, a legal arrangement dating back to the Crusades, where a knight would leave his lands in the care of a trusted friend while he went off to war. The friend held the legal title, but the knight retained the equitable interest. Smith saw that the American industrial barons were fighting their own wars, building railroads and slaughterhouses, and they needed a steward who would not gamble with their reserves. He established Northern Trust not merely to lend money but to act as a fiduciary, a legal concept that binds the institution to act solely in the best interest of the client, placing the client's survival above the bank's own profit. The true test of this philosophy arrived 4 years later, during the Panic of 1893. Financial panics are the fever dreams of capitalism, moments when the collective hallucination of value collapses and men wake up to find their paper fortunes are ash. Across Chicago and New York, banks that had overextended themselves on railroad speculation shuttered their doors, and lines of terrified depositors snaked around city blocks, banging on iron grills, demanding gold that did not exist. In the midst of this hysteria, Byron Laughlin Smith did something that would define the psychology of his institution for the next century. He did not lock the doors. He reportedly brought bags of gold coin from the vault and stacked them in plain sight of the tellers' cages. He stood there, calm and immaculately dressed, and invited anyone who wished to withdraw their money to do so. The sheer audacity of the display, the visual proof of liquidity, broke the panic. The depositors looked at the gold, then at Smith, and went home. They realized that this was not a place where money was played with, it was a place where money was kept. This incident highlights a critical distinction in the sociology of the elite, which is the difference between rich and wealthy. The rich man is obsessed with growing his fortune, terrified of missing the next expansion. The wealthy man, the client of Northern Trust, is obsessed with not losing what he has. He is driven by the fear of regression. This is why the Northern Trust, often called the Gray Lady of LaSalle Street, became the custodian for the great industrial families of the Midwest, the Armours, the Fields, the Swifts. These families had already won the game of capitalism. They did not need to roll the dice again. They needed a mechanism to transfer their winnings to their children and their children's children without the erosion of taxes, divorce, or incompetence. The primary tool for this preservation is the Dynasty Trust, a financial instrument that Northern Trust perfected. To understand the Dynasty Trust, one must look at the rule against perpetuities. For centuries, English common law held that a dead hand should not control property forever. A trust had to expire roughly 21 years after the death of the last potential beneficiary alive at the time the trust was created. It was a legal safeguard against a permanent landed aristocracy. However, throughout the 20th century, states like Delaware, South Dakota, and eventually Illinois quietly eroded this rule at the behest of the banking lobby. They created legislation allowing trusts to last theoretically forever. Northern Trust utilized these shifting legal sands to construct vessels where assets could grow tax-free for generations, shielding the capital from the estate tax, which is the only mechanism the state possesses to break up dynastic power. When a fortune is placed in such a trust, the beneficiaries do not technically own the money. The trust owns the money. The heirs merely enjoy the income. This distinction is crucial because if the heir is sued, or divorces, or goes bankrupt, the creditors cannot touch the principal, because the principal does not belong to the heir, it belongs to the silence. The physical architecture of Northern Trust reflected this separation from the common street. In 1906, the company moved into a new building that was designed to look less like a place of commerce and more like a mausoleum or a temple. It was heavy, granite, and imposing. Inside, the atmosphere was one of hushed deference. This was not accidental. The design was a form of psychological conditioning. It reassured the nervous heir that the bank was more permanent than the government, more stable than the currency itself. It also served to intimidate. The relationship between the trust officer and the beneficiary is complex, often mirroring the dynamic between a strict parent and a dependent child. The trust officer controls the purse strings. He decides if the request for a new yacht or a vineyard in Tuscany falls within the definitions of health, education, maintenance, and support, the standard legal language, known as HEMS, that governs discretionary distributions. The bank becomes the surrogate patriarch, enforcing the discipline that the original founder can no longer impose from the grave. As the 20th century progressed, the nature of wealth shifted. The factories and railroads that had generated the initial fortunes were sold off, replaced by diversified portfolios of stocks and bonds. Northern Trust adapted by becoming a pioneer in the concept of the family office. A family office is exactly what it sounds like: a private corporation whose only product is the management of a single family's life. Northern Trust began offering these services to families who did not have the scale to build their own. They took over the mundane, granular details of existence. They paid the bills for the horse stables in Kentucky. They managed the payroll for the household staff in Palm Beach. They handled the insurance claims when the vintage Ferrari was scratched. By doing so, they rendered the wealthy completely helpless in the face of practical reality. The client becomes an infant in the world of logistics, tethered to the institution for the basic functions of survival. This stickiness is the envy of every modern software company. But Northern Trust achieved it with leather binders and fountain pens. During the Great Depression, while other banks were collapsing under the weight of bad loans, Northern Trust saw its assets grow. Money fled from the speculative banks to the conservative ones. It is a recurring pattern in financial history that, in times of catastrophe, the boring endure. The bank had maintained a liquidity ratio that other bankers mocked as inefficient during the Roaring '20s. They held nearly half their assets in cash or government bonds. When the crash came in 1929, they did not have to call in loans to survive. They simply waited. This conservatism is not merely a business strategy. It is a moral stance. It posits that the preservation of capital is a higher virtue than the maximization of return. It appeals to a specific type of guilt that haunts the inheritor, the guilt of unearned privilege. The heir knows he did not build the fortune, so the very least he can do is not lose it. Northern Trust sells the alleviation of this anxiety. In the modern era, the mechanisms have become even more arcane. The bank now helps clients navigate the global archipelago of tax neutrality. They utilize structures like the Grantor Retained Annuity Trust, or GRAT, which allows a wealthy individual to transfer rapidly appreciating assets to their heirs with little to no gift tax. The mathematics of a GRAT are complex, involving the calculation of a hurdle rate set by the government. But the principle is simple. It is a bet that the investment will outperform the government's expectations. If it does, the excess value passes to the next generation tax-free. If it fails, the assets simply return to the grantor as if nothing happened. It is a coin toss where heads means the family wins and tails means the family breaks even. Northern Trust operates these levers with the dispassionate efficiency of a surgeon, removing the tumor of taxation from the body of the estate. Consider the Northern Trust's involvement in the administration of blind trusts for politicians and public figures. This is another layer of the service, the manufacturing of ethical distance. When a wealthy individual enters public office, they must avoid conflicts of interest. They hand their assets over to the bank, which manages them without the client's knowledge. The client can honestly say they do not know where their money is invested, but the bank knows. The bank ensures that the portfolio tracks the general health of the economy or the specific sectors that the client's class dominates. It is a performance of ignorance, facilitated by the highest levels of competence. The money continues to work, unseen, while its owner stands on a podium and speaks of public service. The culture of the bank itself remains strikingly insular. For decades, it was known for having a remarkably low turnover rate among its staff. One did not join Northern Trust to become a star trader and burn out by 30. One joined to become a fixture. The relationship managers often stayed with the same families for decades, becoming privy to secrets that the clients would not share with their spouses or confessors. They knew about the illegitimate children, the secret addictions, the impending divorces before the papers were filed. This institutional memory is a formidable asset. When a bank knows the psychological topography of a family for 3 generations, it can predict the fault lines. It knows that the grandson is weak and will need a spendthrift clause in his trust. It knows that the daughter is sharp and should be groomed for the foundation's board. They manage the human capital as ruthlessly as the financial capital. One of the most potent examples of their reach is their dominance in the custody business. Custody is the most boring, invisible, and vital part of the global financial system. When a pension fund or a sovereign wealth fund buys a stock, they do not physically hold the certificate. The asset is held in custody by a bank. Northern Trust is one of the largest custodian banks in the world, safeguarding trillions of dollars in assets. They are the librarians of global capitalism. They keep the records. This gives them a vantage point that few others possess. They see the flow of capital before the market reacts to it. They see the frantic rebalancing of pension funds in Tokyo and the liquidation of assets in London. This data is not shared, it is distilled into insight, ensuring that the bank remains an unshakable pillar even when the markets tremble. It is rare to see a Northern Trust advertisement on a billboard or a subway car. They do not sponsor football stadiums. Their marketing is discreet, targeted at golf tournaments and art fairs, places where the silence is already established. They sponsor the noise-canceling headphones of the cultural world. This invisibility is strategic. In a democracy that is increasingly hostile to the concept of dynastic wealth, the smart money does not want to be seen. It wants to be boring. It wants to be buried in the footnotes of a ledger, shielded by layers of limited liability companies and irrevocable trusts. Northern Trust provides the camouflage. They allow the ultra-rich to mimic the middle class in appearance while operating as sovereign entities in practice. The endurance of the Northern Trust suggests a troubling truth about the nature of American society. We are told that this is a land of opportunity, of creative destruction, where fortunes are made and lost in a single generation. But institutions like this exist to arrest that cycle. They are engines of stasis. They are built to freeze the social order in place, to ensure that the winners of the 19th century remain the winners of the 21st. The mechanism of the trust, The tax avoidance strategies, the family office services, all are designed to negate the effects of time and chance. They create a hermetically sealed environment where failure is impossible because the cost of failure has been prepaid. When one walks past the heavy stone facade of a bank like Northern Trust, one is not looking at a business. One is looking at a fortress built against the future. The people inside are not merely bankers. They are the keepers of a flame that burns cold and steady, consuming nothing, warming no one, but illuminating the terrifying permanence of things. The money that Byron Laughlin Smith stacked on the counter in 1893 is still there, in one form or another, transmuted into electronic digits, compounding quietly in the dark. The men who made it are gone. The city around them has burned and been rebuilt. Ideologies have risen and fallen, but the trust remains. It waits, patient and indifferent, watching the world scurry by, secure in the knowledge that while men are mortal, capital, when properly tended, is eternal.